Yeah, no problem.
Awesome. Thank you.
Perfect. Okay, thanks, Katie. Yeah, so as I said, being a lawyer, of course, you're going to see a legal disclaimer here because this is not intended to be legal advice, but it is intended to be a high-level overview for you and to encourage you to ask questions and to also seek out professional legal advice from qualified legal professionals before you advance further in your decision-making in terms of raising capital for your companies. So we can flip to the next one. Oh, the one thing I didn't mention was like I've been involved with SheBoot since the beginning. So I just wanted to just let you all know that I've been working with Jennifer and Julia for many years, and both with the Capital Angel Network, and then was super excited to be involved with the SheBoot the whole organization and setting it up and really excited about the successes that we've had so far. So looking forward to many more. So today we're going to be talking about a few things from a legal workshop perspective, due diligence in capital raising. So to give you some idea as to what an investor is going to be looking for when they're deciding whether or not to invest money in your company, the types of offerings that are available and are sort of typical, and also the types of investors that might be interested in funding your company. And we'll look at those from not just the early stage, but also as you progress in your company's development. And then we'll have also a little dive into some typical deal terms, both from the legal perspective and from the investor's perspective. And then I guess we can flip the slides. In terms of due diligence, we'll dive into that one first. So the types of things that an investor is going to want to look at when they are looking at whether or not to invest in your company is things like your corporate records. So that would be your minute books. You'll hear them referred to as your minute books. And we'll talk about what they are looking for when they're looking at these records and what they would like to see. Also, they'll want to have a dive into your cap table. So if you've done any other issuances of shares to people that have maybe worked for you or made promises to do so, they'll want to have a dive into your cap table. So we'll talk about that as well. They will want to look at any intellectual property rights that you've protected. And so we'll talk about that, as well as if there's anything specific to your business and your operation that is of concern from a regulatory or compliance perspective. We'll talk just a little bit about that as well. So when you incorporate your company, I'm just going to ask, like, have you all incorporated your companies already? Yes? Is there anybody who hasn't? Okay, so that's good. So I'm hoping that when you incorporated your company, you did obtain some legal advice, because often we'll have clients that will just go online and incorporate their company themselves and maybe not set it up properly. So when you are looking to raise money and to have investors invest in your company, they're going to want to ensure that your company is actually properly incorporated and has issued shares properly, so that, you know, if you're the sole owner of your company, you own all of the shares. If you've done any other types of financing, they'll want it. Everything should be properly documented and included in your minute books in that respect. And the other thing is just to make sure that all of your annual filings are up to date, because depending on whether or not you've been incorporated federally or provincially, if you haven't kept your annual filings up to date, the company can be deregistered by the government for not paying annual filing fees and that sort of thing. So you just want to make sure that you're on top of that.
And just to add, in terms of incorporation, I have dealt with a couple of startups over the years that have incorporated, but either used a lawyer who's not used to sort of tech corporations, or they used Google to figure out how to do it, and had to redo share issuances and share classes and things at the time that they raised money, which is expensive and can really slow you down. Yeah, so Cheryl's gone
Nice,
through
nice note, Cheryl. I love it. Yes,
Yeah.
I can tell you it is a lot more expensive to fix it after the fact than it is to get the advice up front and
Yeah.
get it properly.
And using the lawyer that you use to buy your house is not necessarily the right
Right.
which is what one of them.
Absolutely. That's absolutely right. So sorry,
right.
just fixing my screen here. There we go. Yeah, so I guess what did we talk about? We talked about the corporate records. Now we're talking about cap tables. So in terms of your cap table, so this is your capitalization table. That's what cap table stands for. And what it is it's just typically it's a spreadsheet. It summarizes all the shares and any sort of convertible securities, anything that you've issued to date, anything that you've made promises to issue. So those all of the issuances and promises to issue shares in your company, those need to align to what's in your minute book. So again, when you have issued shares, all of that should be documented properly into your minute book and have resolutions that are authorizing those issuances. And depending on the nature of the securities, and we'll talk about the nature of the different securities available in a minute, but so, you could have convertible notes, you could have safes, you could have common shares, you could have stock options. Like often when people are getting others to work for them in their company, they'll make promises of issuing options and so that they can keep the salaries lower. Anything that you do like that needs to be properly documented and included in your cap table. So I see there's a question. Is that from Rashmi? Did you want to chat about that, Rashmi, or?
Oh, sorry. I saw that Cheryl had made a comment about needing to spend 13,000 to fix their
Oh.
incorporation. And so, yeah, I I was curious about what might have happened just so that I'm aware and make sure that I if I need to do that or if, yeah.
You guys hear me?
Yeah.
Okay, I fixed it. I was gonna say, just like quick Coles notes on that. So we used Owner to do our incorporation and just determined like what we, having never run a business or a startup or raised money before, like thought was the best structure. And then all of our share structure was wrong. We needed to reissue and repurchase our shares from the founders and issue new stuff. And then we also went through like a founder exit at that same time. So that did complicate it, but we had to like pay quite a lot just to get them to fix the share structure. That was the biggest issue.
Right.
Yeah, and that was one of the two companies that had messed up their incorporation. It was the share structure, and they had issued shares instead of because they had no money. So they paid a bunch of people to help write the code in shares, but the share structure was incorrect. So all of that had to be reissued. And that was expensive.
Yes. Yeah.
Yeah.
Yeah. And you also have to be careful in doing that because when you are issuing shares for services, there's a lot of tax implications to doing that for both the company and for the person who is receiving the shares. So yeah, I would just strongly suggest that you get advice before doing anything like that. And we do see it happen quite often, and it definitely is more expensive to fix after the fact. Yeah, so yeah, I think that's it for that slide, unless there's any questions in terms of, I think I did see another question. Sorry, I don't have the chat open. I should open it. There we go. Yeah, so I think Tally had a question about safes and convertible notes. Yeah, we'll get into that, what your cap table needs to reflect a little bit in more detail in a moment. But yes, everything that you do that is a security that you're issuing should be reflected so that the investor has a full picture of what's happening in your, what obligations the company might have for issuing additional shares. So the other thing in due diligence that investors are going to want to look at is how you've protected your intellectual property. So, that would include whether you're keeping what you've invented or any sort of trade secrets that you have, if you're keeping those as trade secrets, or if you've determined there's something that's patentable there, whether you've started to make an application for patents, you know, where you are in that journey is really of interest to investors. They'll also want to know, you know, protecting your name and your brand is also a very important thing to consider. Because if you know, you've incorporated your company and you have your name and you carry on and you start having some success, if that name is actually been registered by somebody else in a similar business, they may have a big issue with that and ask you to change your name after the fact, which is always a big pain for people, and again, can cause you more pain and expense after the fact. So super important just to keep all of those things in mind from a due diligence perspective. This is what investors are going to be interested in. The other thing to keep in mind is before you start talking to people about your secret sauce, about what your business is doing and why somebody would want to invest in it, just make sure you protect, if you haven't registered a patent, or if you haven't registered, you know, a trademark or whatever you're doing, just make sure people are signing non-disclosure agreements so that they are bound, they're keeping your information that you're sharing with them confidential. In particular, also, if you're going to be sharing your financial information, that's confidential to you. You don't want to be sharing that with somebody who hasn't agreed to keep that confidential. The other thing important to remember from an intellectual property diligence perspective is anybody who's been involved in developing your product or your service, whatever it is that you're doing, they should be signing a document that waives their rights in the products that they've developed for you as an employee of your company. And even if you've hired them as a contractor, an employee, or you're only paying them with shares or options, or however you've determined you're going to do this, it's super important that they sign a document that assigns all of their rights. Because if I'm a code developer, for example, and you've hired me as a contractor on a temporary basis just to help you develop code for your product, if I don't waive my rights in that code, I will have ownership rights in that code. And so that's something of key importance for both your development of your company and your products, but also from an investor's perspective, they want to know that you actually own the products that you're going to be purporting to sell.
And this is true even if you are using friends for free, or if you've gone to college or a university. Yeah, you just need to make sure no matter how little you're paying them, how much they're volunteering, that you've got the rights to the intellectual property.
Yeah, that's a really important point, because often, you know, people will say, well, they're just doing it as a favor to me. I'm not even paying them for it, but they will have rights in it unless they've waived those rights. So really important to make sure you've got that covered before you enter into a due diligence exercise. In terms of compliance matters, so, you know, depending on the nature of your business, you may have, there may be privacy compliance issues, depending on if you're collecting data or any sort of information from your customers. Also, you know, if there's a finance element to your company, there's FinTrack obligations to comply with. If there's any sort of exchange of money happening that you may be deemed to be a money services business, there's all kinds of things, just depending on the nature of your business, that you should just keep in mind from a regulatory perspective. There may be hoops you have to jump through and make sure that you've got the proper you know, compliance elements in place before you start going through a due diligence exercise. And yes, the new Quebec Law 25 is very crazy. I agree. It's been a struggle even for law firms complying with that. So there you go.
I don't know. Yeah, I feel like it's this huge monster that's about to eat me. I don't know like what to do about it. Like I feel like we all just need to hire privacy lawyers to help us right now.
It's unfortunately true, because it's very complex to navigate and to make sure that you are in compliance. And yeah, it is something that you should consider. And yeah, like, I mean, the practice area of privacy law is booming because of all of these changes that have happened in the laws. But yeah, super important to actually get the advice you need, because to be not compliant could be debilitating depending on the nature of your business. So, yeah. Okay, next slide, Katie. Thank you. So then we'll talk about the types of offerings that you might come across as you're going through your capital raising ventures. So, we've got early stage seed. You're likely mostly all in sort of early seed stage of investing. You may have had friends and family that have already given you some money, helping you along. You're now entering into sort of an angel investor phase. So typically the types of instruments we see in these phases are common shares, a convertible note or debenture, and what's called a simple agreement for future equity. And we're going to get into the details on each of these types of offerings. The one thing that I wanted to highlight here is you really need to ensure that you understand that every time you issue a security, which includes all of those things, you need to comply with securities laws, which requires you to follow the issuance of shares or notes or any sort of security to fall within a prospectus exemption. So otherwise, you would have to file a prospectus in order to issue these shares to comply with securities laws. And so there are all kinds of exemptions, and you will typically fall within one of these exemptions. It's just really important to know that this is a requirement, and that when you're documenting the documents that are going to cover the receipt of these funds, or are going to make sure that you cover off the prospectus exemptions that you're relying on. So right now you've probably got the ability to rely on founder, employee, family, close friends, and accredited investor exemptions. We can get into those more if you have more questions, but we'll maybe to kind of start off talking about we'll come back to these and talk about them in more detail, and we'll also talk about, I'll just give you a high level in terms of what happens in your later stages of your company's development. And after you've done these types of fundraising, you're going to get into some later stage fundraising. So maybe we'll just flip to the next slide for that, Katie. And so when you've gone through a few rounds of seed and investor and angel investor financings, you may end up entertaining venture capital or private equity. And those will be getting into more Series A and Series B and preferred shares, and often they be issued in series. And those are when you're getting into much larger sums of capital that you'd be raising in those instances. There's also public markets as an option for raising additional capital. And the other thing just to keep in mind is there is debt financing available, and you might often consider as opposed to getting into a preferred share offering. It's something just to keep in mind, because we'll get into a little bit, but you can end up losing a lot of rights in your company depending on the terms of those investments. And so just always keep in the back of your mind that sometimes a little bit of debt financing is not a bad idea. I think now we can get into, we're talking about term sheets now. So I don't know, I think we are going to talk more about the deal terms as part of the term sheets, but so what a term sheet is just basically an overview of the key terms of the proposed transaction, which would be an investment in your company. And that's just to guide the discussion of an outline of what the terms of the deal are going to be. And so it's always a non-binding document. And even though it is a non-binding document, I would strongly encourage you to involve your legal advisor in the preparation of this term sheet before you sign it, or at least review it before you sign it. Because once you've signed it, the investor will expect that the terms that are in there are going to be reflected in your actual investment documents. And so always important just to make sure you've had a legal advisor look at those terms before you sign off on them, even though it's a non-binding document. I don't know, Jennifer, if you want to weigh in on that.
Yeah, I mean, you do want to make sure, because the term sheet is as you're discussing with your various investors, that's where you're going to document, the type of vehicle you're planning to use, the high level terms for that vehicle. You will want to understand the implications in that term sheet because it is generally a signed document. And while it might not be legally binding, if you substantively change things between the term sheet and the investment document, you may lose your investors.
Right.
Because largely investors feel, when they've got the term sheet that they've done the negotiations and now they're just looking for the final T's and C's in the document. So it's always good to understand what the implications are of what you're agreeing to. And sometimes they are not obvious, which is why you want to have someone with experience in these looking at it for you or with you.
Yeah, that's right. And I think as we go through, you'll get some idea of what we mean by that. So I think we can go to the next slide.
We do have a couple of questions in the
Oh,
chat.
sure.
I'm not
Sorry,
sure
yeah.
if that's okay. Cheryl asked from an investor perspective, I think this was on the slide previous, but from an investor perspective, is there a ceiling or red flag ratio, I think, of equity to debt financing? Yeah, thanks, Cheryl. Yeah, if you guys can see in the chat, if you want to comment on that.
So as an investor, the red flag on debt financing is really related to your potential for profitability and cash flow. So if you've managed to get someone to give you a lot of debt, but you don't actually have a really good way of paying that debt back, that will be a red flag. Some people will give you debt and you're putting your house on the line. And it's okay. So you lose your house, but I don't lose my investment.
Not so.
But generally, what I would look for in debt financing is what are the terms? How many years do you have before you start paying back that debt? If that debt is getting paid back now, then how much of my investment is just going to paying your debt versus growing your company? Because I'm not interested in investing in a company so that you can pay your debt. I'm interested in investing in a company so that you can grow and we can all make more money. So those are the things that I'd be looking for in debt. If you're not paying that debt back, some of the government debt vehicles, you get several years before you have to start paying it back. And so then I'm looking at, for that debt, what's your time frame to profitability and how are you going to start paying back that debt without bankrupting the company or eliminating your ability to grow? On the other hand, debt is cash that doesn't dilute everyone's investment. So it can be positive. You just have to have a plan on how you're going to pay it back while still growing your company. So that's really the trade-off when you're looking at debt. And generally, being able to keep a roof over your head and feed the family. So that it's not onerous terms. Like sometimes people get debt that's really high interest. But if you're getting debt from the government, it's usually reasonable interest and usually reasonable terms. And then it's just, have you debt financed at a level that makes sense for your time frame to profitability and your cash flow.
Great, thanks, Jennifer. So in terms of, we can talk a little bit more about debt from the perspective of a convertible note or debenture. But so these are commonly seen in new companies that are trying to raise capital. Often, what a convertible note is basically it's a debt, it's a promise to pay, and often it will collect interest. The convertible nature of it makes it available to be repayable by issuing shares. And so that's why, excuse me, it's a convertible note or convertible instrument that's convertible into shares on maturity, or that maturity could be triggered on a specified date or by a change of control or a qualified financing event. So the terms of that note will set out what the triggers for conversion are. You have always the option to pay it out in cash rather than converting it into shares. But, you know, so there's different opportunities depending on what's happening. In terms of other instruments other than common shares and convertible notes are commonly seen something called a SAFE. So that's a simple agreement for future equity. And often you see that entered into when people aren't really sure what the value of the company is. And so what they do is the company will receive money in exchange for a document that's a pretty simple document. That's right in the name that it's a simple document. And it will provide that the amount of money that's been invested is going to convert on a qualified financing or an event or like a sale of the company into shares that are similar to, have the same sort of attributes as the shares that are issued in that qualified financing. There's also an opportunity often in these safes for the investor to be repaid on if the company is dissolved. So something to consider whether or not this is something you'd be interested in, but I'm going to let Jennifer weigh in because I know from angel investors' perspectives, they may go for a convertible note, but I think there's not a lot of interest that I'm hearing anyway in safes at this point. But I always want to just highlight that it's an instrument that is out there and has been used in the past. I don't know, Jen, if you want to weigh in on preferences
Yes.
from the investor's perspective.
So I know that some of you have started trying to raise, and almost undoubtedly you have been given categorical views on whether or not you should be using a SAFE or a convertible note. Some companies do raise early rounds with equity, but it's not common because you have to get more exact in terms of your company valuation with doing an equity round. But I have done equity rounds as the first angel round. I've done safes, I've done convertible notes. So the issue with the safe, and the reason why many angels don't like safes, and other angels will tell you that you should only do safes, is that safes work best if I know for sure you're going to get a Series A, Series B. Because I know that an institutional investor, I mean, you might go under, but like when I look at some of my investments, their path to success goes through a VC because they are in a market that needs so much money that I know they will have to raise from a VC. And if I know that they have to raise from a VC, I can do a safe because I know it will convert. As long as the company is succeeding. And if the company doesn't succeed, it doesn't really matter whether I used a convertible note, a safe, or equity if you don't make it. But if you do make it, if I know you need a VC round to be successful, I will do a safe if that's what you want to do. But some companies can get to profitability without a VC round. And if I have done a safe with a company that got to profitability without a VC round, my money is just sitting there. It's not going to convert to debt and it's not going to convert to equity. It's just sitting there. So you've got access to my money, but I have no way of getting it back. So if I've done an equity deal and you get to profitability, you can dividend out, there's ways you can start repaying your investors in an equity deal when you get to profitability. If it's a convertible note, then when it hits the maturity date and you've managed to get yourself to profitability, it can convert to debt and you pay back the debt, or it can convert to equity and then, you work out a dividend plan on your profit sharing to pay back the investors. But the safe just sits there. And, the safe, because it's not equity, it's not debt. And that's why some investors will look at you and say, no, I'm not doing a SAFE. Because it can just sit there. And I certainly have one of those where the company is operating, my SAFE is still a SAFE. And there's no foreseeable event that's going to cause me to get anything out of that investment. And that's, so what you need to look at is what your path is, what your fundraising path is. How are your investors going to make money? And what's the best vehicle given your path for you and your investors to make money on your company?
I think Sakina has a question.
Yeah, thank you for that. So my question is, so I'm in a unique situation because of religious reasons. Like, you know, I'm Muslim, so we do have this injunction against taking anything that has interest. So, for example, convertible note would be something that I'm not comfortable with because of, you know, what I practice. So when we go for an equity round, is there anything that entails any sort of interest-bearing instrument? Like, does it have it, or is it just straight up, you're giving me this percentage of investment for my valuation, and you get an X percent of the shares in the company?
Yes. Yeah. So if you're doing an equity round, then you are selling me shares. And depending on the timing of the round, if you're doing a very early round, angels will come in on common shares, which is the same shares that you have as the founder. You know, so you've got, you know, a relatively low valuation of your company because you're early. Your early investors are on the same share class. That's easiest. So if you do a common share and you've got common shares and you do a common share equity agreement, that is the simplest paperwork. There's no long-term things that you need to worry about. You've just got a bunch of investors that are on the same terms and conditions as yourself. It's actually, people will tell you equity rounds can be expensive. And they can, and I think Lorraine has a slide on all the various terms and conditions that you can wind up with in a deal. But a simple common share agreement when your company is still new, fairly new, can be really cheap to do the pay. I mean, not cheap, but
It's definitely more simple.
It can be more simple, right? When you're just doing a common share agreement. And then, you know, the agreement you really have with your investor at that point is if your plan is to get to profitability and operate your business, that you've got some plan of doing dividends to share the profits, or if your plan is an exit either through a public market or an acquisition, then, you know, all your investors will get the proceeds back from that event. But there's no interest on it. They just own a part of the company along with you.
Thank
Tally?
you.
I think Tally has a question as well. Oh, we can't hear you. I think you might be muted.
Okay, sorry about that.
Yes.
So about the point that Jane just made about that was really interesting, the discussion of what investors are considering and the risks that they're foreseeing with a company that might not be, you know, a right fit for VC funding. I guess the flip side though is and I hear what you're saying, but could subsequent investors, so like VCs, potentially look at a convertible note and say, hey, this is a company.
You just muted yourself with your hand waving.
I don't know how that happened. Okay. Could VCs come back and say, yeah, well, this is clearly a company that needs VC money, like whatever, you know, the profile of the company is, it's obvious that they can't scale without VC money. So the fact that the initial investors were not confident, that it must be that they weren't confident that VC money would be given. Not that this company needs VC money, that's obvious, but that VC money would, like, there would be, you know, an uphill battle to get it. So I'm just, maybe I'm paranoid because I'm also a lawyer and it's like, you know, you just worry about everything. So I could see VCs kind of taking a few points off of a startup like that potentially, in the sense that, like, you know, some investors didn't have the confidence to put it into a safe when, like, clearly this company would need VC funds. That's, I mean, just my sort of paranoid reaction to that.
So, I've never seen that.
Okay.
I have, you know, I have had VCs that, you know, don't understand why you would ever consider a convertible note versus a safe. Safes are just easier. You should always do safes. But if there's convertible notes on the cap table, I've never seen it come up as an issue versus a safe. The only thing that you do need to watch on a convertible note, because I have had convertible notes that we have extended the maturity date. And what you need to watch when you extend the maturity date is keep track of the math. And this is, you know, your cap table is really useful for keeping track of the math. Because your convertible note will have interest. And, you know, the interest rates are starting to come down again, but for a little while, the interest on convertible notes was fairly high. So if you went to some of the early seed, like I've seen convertible notes, the SheBoot one I think is 8%, but I've seen convertible notes that were 12% interest. So when you look at the cap on the convertible note and you look at the interest on the convertible note and you think, okay, so I've got a maturity date that's 2 years out. Everything's great. I still have control of my company when this note converts in 2 years. But then you don't raise, you know, because it's getting harder right now. We were in a really easy VC fundraising time. You know, 2 years ago, there was so much money around, everybody was raising, and then things, or maybe that was 3 years ago. And then things really slowed down, right? You know, there's a lot less money sloshing around the system. It's taking longer to close VC rounds. So you extend your maturity date with your investors. Do the math again. So now that convertible note has 4 years of interest on it instead of 2 years of interest by the time it converts. Right. So make sure that when you're doing a convertible note, that the combination of the cap, the interest, and the time horizon doesn't give most of the company to those investors.
Exactly.
It's not what those investors are trying to do. They're, it's in everybody's best interest for the founder to be highly motivated to keep growing the company. So I'm not trying to take over the company from you because I have no interest in running your company. Right. But I'm trusting that you're doing the math to make sure that you have enough ownership as you go through this process. And that's why, you know, if you need to extend a maturity date, you need to rerun the math.
Yeah. And yeah, that's why it's so
Yeah.
important that you include all of those convertible securities in your cap table so that you know at all times how much of the company you actually own.
Yeah.
Yeah.
Yeah. And if you do multiple convertible notes or multiple safes, that you're doing the math on all of those to make sure you understand what your final ownership is going to be at different levels of investment. And I have had a company where we had to renegotiate the convertible note because of exactly that issue.
Yeah.
The VC wouldn't invest because the angels owned too much versus the founder based on the conversion. So the note got renegotiated to reduce the angel share so that the VC would come in, which we did because, you know, the alternative was losing your money. So,
Right.
but it's cheaper to do the math in the first place and make sure you understand what you're giving away. So.
Thanks, Jennifer. Yeah, so I guess we've beaten that a little bit. So we can go to the next slide. Yeah, so economic deal terms. So there's different types of terms you'll see in the term sheet. There's economic deal terms and control deal terms. And so economic deal terms are things like conversion rights. There may be a cap and maybe a discount. There will be preemptive rights and dilutive provisions. Liquidation preferences, for example, depending on the types of shares that are being offered. Those are sort of economic deal terms that will be set out in the term sheet. And then there are control deal terms, and those would be things like the voting rights that a shareholder gets, whether or not they have representation on the board of directors, whether they get to nominate or be an observer on the board. Do they get information rights, like rights to financial statements, that sort of thing. There's also sometimes you'll see in control deal terms, you'll see something like a majority investor, a major investor shareholder definition that will give certain protective rights to those major investors. And so we're going to get into each of those. This is just a sort of high level list of the types of things that you are likely to see in a different term sheet, depending on the type of offering you're entering into. So if we go to the next slide, in a common share offering, as we were just discussing, you need to have a valuation of the company in order to put a value on the shares. And so that is sometimes very difficult if the company isn't in a place where they can convince an investor as to what the anticipated value of the company is going to be as a result of the investment, what their growth plan is, that their business plan isn't sufficient to show an investor what the value of those shares that are being offered to them really is, then that's where you'll get into this request from an investor to have something other than a common share offering, because they're not quite convinced that the value maybe is in the shares that they're purchasing at the price that you're asking for. And so that convertible note then gets put in place, or you're safe, and that valuation is then left to the subsequent financing to determine the value of the company at that time and the value of the shares that you're converting into. And as I said before, normally what you're converting into under a convertible note or a safe is the same type of shares that are issued on that subsequent financing, usually at a discount around 20%, or with a cap on the valuation of the company, so that there's some certainty for the investor as to the advantage that they're getting by coming in early with their money, and they're seeing a return on that investment. I don't know, Jen, if you wanted to weigh in on anything else there.
Yeah, so I'm going to weigh in a little bit on the cap.
We're
So
gonna have another slide on that if you want to wait till we get there.
okay, because I was
I've got
just
a
going
little
to
bit
say
more detail on that, which may be helpful to that conversation.
all right, yeah, because I was just going to say like the negotiation of the cap, as an investor, I'm going to try and negotiate the cap as close as I can to what I think your current value is. And you know, depending on how successful I am at that, you might as well have just done a common equity deal versus that cap, especially if it's a note, because the note also has interest, you know, that's coming into play. So if I've negotiated the cap close to what I think your value is, and then I've also got interest coming in, you know, you may have been better off doing an equity deal at that point. As a founder, the founders typically come in with the cap closest to what they think the next round will be. And that's where the negotiation comes in, is trying to get to that, because what the investor, as an investor, what I'm looking for, if I'm coming in on an angel round, I am looking for a risk premium. So you're going to have the use of my money for a year or two to get yourself to the point that you can get a VC investor to invest. So I'm taking a higher risk than the VC will be, because I'm investing earlier, and I want some sort of return on that risk that I'm taking for that, you know, year or two before you get to the VC. So that's where the cap and the discount, and if you try and do just a 20% discount with no cap, you won't find any angel takers, because it's just not enough of a premium on getting the use of the funds that much earlier, and the higher risk that the angel round is versus the VC round.
Yeah, thanks, Jennifer. So this slide is just articulating of, I think, in more legal terms, what Jennifer has just been describing to you. Yeah, so typically you'll see that the valuation cap set at the lower of what's been negotiated in the convertible note, or the pre-money valuation just prior to what's been agreed to in a subsequent round. And then you'll get into the negotiation around a discount on the price per share at which the convertible debt or note or safe will convert into equity. And as Jennifer was just describing, like, so, you know, if you've got both a cap and a discount, then they typically your instrument is going to provide that they're not going to both apply, because the investor is going to get whatever one is to the investor's advantage. And I think that's basically what Jennifer was just describing to you. So any questions on that? We're good. Okay, next slide. In other economic terms that you may see, depending on the nature of the round you're doing, is pro rata or preemptive rights. And so what these mean is a participation right that's on a pro rata basis will allow the investors to maintain or expand their share of your business by participating in future financing rounds. And so this allows the investors to protect against being diluted. So often you don't see something like this in an angel round, but you may see it as you progress into subsequent rounds. Other things you might see as well in preferred shares would be a liquidation preference, and that would be in your Series A when you're getting to more into venture capital rounds. And what those liquidation preferences do is provide a holder with a preference in respect of the repayment of their capital over the common shareholders. And this is where, so they get their money out first. So when you start to enter into negotiations on these types of terms, it's super important that you understand what that means for you as the owner, as the founder, how you're being treated at the end of the day. Are you still going to end up with more than 50% of the issued shares in your company, or does this liquidation preference mean the investor is actually now going to be a more significant shareholding than even perhaps you do? So again, another reason just to keep on your cap table and always be thinking ahead to where you're going and what any convertible instruments that you've issued, what that impact is going to be as you progress in your capital raising efforts.
Just a comment. So pro rata rights. So that says that, you know, I come in on an angel round and I want to make sure the VC can't shut me out, so that I can double down my investments on my winners. So the pro rata right says, you know, when I invested, I have the right to invest in the next round up to a certain percentage. So early investors will look for that because they want to be able to go in on the next round and when you're successful. And occasionally you will find, you know, a seed investor that tries to block that for the angel investors. So those are the sorts of things like we have, you know, I tried to do a deal. I actually backed out of it because they had a seed VC and angels on the round. And then the seed VC said the pro rata, you had to own X percent of the company before you could get pro rata. And that locked out all the angels from pro rata. So all the angels dropped out of the deal. You know, and that delayed closing by several months when that happened. And those are the sorts of things that you need to look at, like when you're getting VC and angels in the same deal, how do those terms work? And can everybody be happy with them? And yeah, and on liquidation, so typical liquidation preference is 1x. So the VC gets their money out before everybody else gets their money out. There have been times when money was really tight. It was really hard to get VC investment. So the VCs own all the cards. And when the VCs own all the cards, they will sometimes do a 2x or a 3x liquidation preference, which means that they double or triple their money before anybody else gets any returns. So just understand those, what that means. It might mean that your exit price has to be really high before you make any money because of the liquidation preference of your investors. So understand that. But typically, if the liquidation preferences are showing up in the 2x or 3x, it's because not many people are investing money. And so, you know, the VCs hold the cards. A couple of years ago, as I said, money was loose. We didn't see those sorts of things. Money is tighter now. You might start to see some of those more onerous deal terms coming from VCs because they know that you're going to struggle to get enough financing.
Yeah, interesting. It is interesting, the cycles, right?
Yeah.
But, yeah. So this getting into control terms. So as I mentioned, so the control terms would include things like voting rights. So only shareholders get voting rights. So if you've issued convertible notes or safes, there are no voting rights attached to those. Only when you've issued actual shares, either common shares or preference shares, would voting rights attach to those shares. Major investors, depending on the level of investment, may want to have a right to nominate a board member to oversee what's happening in the company. They may also, as I mentioned, request information rights. So they'll want to see financial statements on a regular reporting basis. And in terms of protective provisions that they may want to include in the term sheet, things like consent rights over, changing anything that you're doing. Like if you wanted to pivot your business, if you wanted to change your name, or you wanted to change your certain things that you might want to do with the company, if you were changing anything to do with your share structure, those terms in either in the actual shares themselves or in another document called a shareholders agreement would be set out there, and that would be highlighted in the term sheet before you got to negotiating those definitive documents. I think we can go to the next slide. When you get to a series A, B, and preferred share rounds, the deal terms you're going to see are more on the liquidation preference side, likely to very much likely see board seats being requested, maybe even more than one, depending on the number of investors that are in. And the investment window is also something to keep in mind when you're getting to this stage of financing. VCs will generally want to see an exit in 5 to 7 years. And if you're not able to get them that exit, then they will exercise their liquidation preference, or they have the ability to do that. So that's always just something to keep in mind when you are looking towards that type of fundraising. Because I've personally gone through that situation where I worked in-house for 10 years at a tech company. And at the end of our 5-year investment window with our private equity investors, they exercised their, I think it was a 3 times liquidation preference, because at the time money was very tight. And it was not a fun experience to go through. It was really good for me as the lawyer to go through that, because I can now actually advise my clients with some knowledge and experience of having gone through it, to say that it actually can and does happen. And so really something to keep in mind before you decide to raise capital from venture capital. You want to make sure that you've got other alternatives for exits within their investment window before you sign up for that kind of investment. I think, yeah, definitive documents. So we haven't talked about the actual documents. We've been talking all about the term sheet and the things that you'll see in typical term sheets. But once you've signed the term sheet and you then go into negotiating these deal documents, this agreed form that so we have to actually document the issuance of the security that you're issuing. So you need to actually have a form of convertible note or a form of safe document, or whatever terms are going to apply to the shares. And to the extent there are classes that are not suitable in your share structure, those things need to be dealt with before the investment closes. Typically that type of stuff doesn't arise until you're actually doing your Series A round, if the security you've issued at this stage is a convertible note or a safe. But it's just something to be aware of for when you actually enter that Series A round. The subscription agreement is really important, as is a shareholders agreement. So these things are the subscription agreement, I'll talk about it in a second, and the shareholders agreement. If just to high level, if you're using the Canadian Venture Capital Association documents, there's that's more typical at your sort of Series A or B stage to be getting into those types of documents. There's a standard set of documents that make it easier for you to execute on these investments. But in terms of the, if you go to the next slide, we'll talk a little bit about the subscription agreement. That document is really necessary, and I've seen, many times investment money accepted into a company, shares issued, but not having the proper forms completed. That puts you offside of securities laws, and so it's really important to have, even when you're doing a common share round, to have a subscription agreement that has the investors complete a private issuer exemption form, because you need to ensure that, or an accredited investor form, depending on the nature of the investor. You need to be, the company is responsible, not the investor. The company takes responsibility for complying with securities laws. And so you have to make sure that you have gotten you've done your diligence. These people are either, they're part of an angel network group, so that they are accredited investors, or else they wouldn't be part of that group. Or you've done your own financial due diligence on them to ensure that they comply with securities laws. They are actually satisfying the accredited investor exemption requirements. And so that's just really something important to stress, because often people don't realize how important these documents are when they are raising capital.
They're also, they protect you as well. I was talking to someone the other day who's involved in a company that one of the shareholders wants to sue the company because they're not doing as well as they had presented in their pitch. But one of the things as an accredited investor, so if you make me fill out all the forms, which is your legal obligation to do so, I am signing a form that says that I understand I am investing in a high-risk venture. I understand that I may never hear from my founder again. I understand that I might lose all my money. I forget, there's 4 or 5 of these doomsday scenario questions that are in this. So I've signed all of this. And so if you're not, I don't know if any of my investments have ever followed their business plan exactly that they pitched at the time that I invested. Some of them have made money, but they haven't all done it in the way that they've said. But it protects you. And it protects you against your investors as well, because your investors will all have signed this, and you've got that saying that they understood that your pitch might not be the way things actually go. So it helps against sort of activist early stage investors, and there are some out there. So you do want to make sure that you're doing all the paperwork, both for securities compliance, but also just for legal protection.
Yeah, and if an investor is giving you pushback about signing those documents, you need to do a little diligence on your investors as well, because they probably aren't somebody that you want to take money from if they're not willing to complete the proper paperwork. In terms of other documents, the other really important document to think about, especially if you are a founder that's co-founding with another founder, anytime you've issued shares to more than one person, you should have a shareholders agreement in place, because again, this is something that's going to protect your rights. Often investors are going to want to have a shareholders agreement to protect their rights as well. It's just a way to be very clear about what rights exist as between the shareholders, and also provides a vehicle for people to get out of the investment. So, or a vehicle for you to get exit investors, if you want to do that. So generally, they're going to set out things like anybody has, any shareholder that has a board nominating rights, that will be set out there. Any sort of special approval rights that shareholders get in terms of different classes of shares, but also just making sure that often the fundamental risks, but there may be other things. In legislation, there's a number of fundamental matters that have to have shareholder approval, but there may be other things that a shareholder would want to have approval rights over, and those would be set out in the shareholders agreement. The other thing to keep in mind is that the shareholders agreement can sometimes deviate from your articles of incorporation, which set out the share terms, and allow you to opt out of certain provisions that may be set out in a governing corporate statute. So, so always just good to get good legal advice, understand what the preferences are that you have, as well as that your investors have, in terms of what shareholder rights will exist post-investment. the other thing, so as I mentioned earlier, the CDCA has a set of model documents, and they split what I refer to as a shareholders agreement into a number of different agreements. So they have a right of first refusal and co-sale agreement. They have, and that protects your sort of pro rata rights. They have an investors' rights agreement, and as well as a voting agreement in those set of model documents.
And can I just, before you go to questions, I just want to talk a little bit more about co-founders. As I think most of you have co-founders in your company, and Cheryl, I think, mentioned having a founder that left the company. So this will be a concern from investors, is what you've got as an agreement with your co-founders. And some people will tell you really don't need a full shareholders agreement until you sell equity in your company. But you do need a co-founder agreement. So the things that have come up with companies that I have invested in, or other members of Capital Angel Network have invested in. Divorce. This can be, if your co-founder is your spouse, but it can also be if your co-founder is married and goes through a divorce, which is one company that we were dealing with. So all of the assets were split. Canadian law on divorce. So, what happens when your co-founder goes through a divorce? So let's say your co-founder is not your spouse, they're going through a divorce. What happens with voting rights? Does the spouse now become an acrimonious voter in your company through that process, right? And this is what happened in this particular case. There were two co-founders. The second co-founder went through a messy divorce. It was very acrimonious. She got half his assets, which included half his shares in their startup. Wound up with voting rights in the startup. And the whole thing was a disaster because they weren't talking to each other. And so anyway, it was a mess. So a co-founder agreement, you can start looking at that. Can the voting rights be transferred? Right? If the voting rights, so one way to do it is, if one person is selling or splitting their shares, so in this case through the divorce, that the voting rights revert to the other founder. So that you, as the CEO, you get those voting rights. They can't be transferred with the shares. So things that you can do around voting rights. Reverse vesting. So your co-founder leaves the company. Do you have the right to take back those shares? Or did they wind up, so if you've split the company, you've got 50-50 shares, your co-founder leaves, they've got 50% of the shares, but they're no longer in the company. So now they're not incented, they're not part of making the company move. You need to bring in somebody else. You don't have the shares to do it because 50% of the shares just left the company. So ways to deal with that is you vest the shares in the first place. So you don't get 50% of the shares on day one. You each get, some shares on day one, but each year that you're with the company, you get more shares. So that's the vesting schedule for founders. And some investors will insist that the founders have a vesting schedule so they don't have all of the shares outright in case one leaves. You can also have a reverse vesting, so shares come back. And you can also have agreements where you can, where they can't leave without giving back the shares. So there's different ways that you can handle it. But you want to make sure that you have enough shares in your company if your co-founder leaves, that you can bring in somebody else and properly compensate them to work in a startup. The question was, can't new investors just renegotiate a new shareholder agreement? Absolutely. This is why some people say don't do all the time on doing a full shareholders agreement until you get to the VC round, because they're going to rewrite it all anyway, and you're going to go through all those legal costs when your institutional investors come in, because they will have a lot of opinions on your shareholders agreement.
Yeah.
And frequently your angel investors aren't shareholders because they've got a say for a no. But whether or not it's a shareholder agreement, you need a founder agreement if you have a co-founder. Right? You need that agreement on what you're going to do if there's a founder breakup or a marriage breakup within the founders, or, you know, a catastrophic event with the founder. How do those shares get handled? How does that company continue? So that's really what you're trying to do. And investors will look for that when there's co-founders.
Yeah.
Is what happens if one leaves. If there's a sole founder, my general assumption is if the sole founder loses interest in the company, it's going to fail. So I personally don't really care whether a sole founder has a vesting agreement or not, because I've never seen a company that's very early that's replaced a sole founder successfully. You know, it's just hard, right? It's your dream, it's your vision. You're committed to it, and then something happens and you're not. It's really unlikely someone else is going to be able to come in from the outside and make it work. But in a co-founder agreement, you know, my hope is if one founder leaves, the other one is going to carry the bag. But the shares will be an issue, voting rights will be an issue. And how does that work? In terms of templates for co-founder agreements, I think that the Mars website might have some templates. I don't know how many of you have looked at Mars DD, but there are template documents on the Mars, which is a Toronto organization, that can help you with that. I'm sure there's other templates around, and you would want to have it reviewed by a lawyer to make sure you've caught a lawyer who's used to startups.
Yes. Yeah, very important.
Yeah. Because startups work differently from like a bakery or other types of small businesses, just in terms of how much dilution happens with the shares and time. But yeah, you will want to, and in fact, investors will generally, experienced investors will generally insist. And what you will find with experienced angel investors is they're going to be very informed by their failures. So if they have been investing for a while, have multiple failures, they're going to tie you up in knots to make sure that whatever caused things to fail in the past are fixed in the deals with you.
Yeah.
But better to be proactive and have something in place. And many co-founders haven't really thought through what happens if one of them leaves the business, and it can be very destructive to have a founder breakup. And my advice, and this is true of all agreements, put the legal agreements in place while you're getting along.
100%. I was going to say the same thing.
And you may think you will always get along. Nothing could ever happen that would break up the relationship between the co-founders. It will always be perfect. But put the legal T's and C's in place, because should something happen and you're no longer getting along, that's a terrible time to negotiate how it's going to work. Much better to go through how it's going to work when you are all getting along and you're all envisioning this will never happen.
Yeah.
And you can have a nice, calm conversation about what to do in this unlikely eventuality.
Yeah, and just to add on to that, it's also a good time, even if in conjunction with that, or if your co-founder has a spouse that they are getting along well and there is no sign of divorce in the future, this is a good time to get them to agree to terms of what's going to happen with the shares that the co-founder owns if they do separate. So it's always good to have these conversations when everybody's getting along. It goes much more smoothly. Cheryl?
Yeah, I just wanted to add on to that, because I think it's really important to also consider that even when you get along, you don't know what's happening in somebody else's head. And that's something that like we learned a lot from, is that we got along. We were best friends, like even when we made these agreements. And then in retrospect, looking back, realizing that actually they weren't coming to this with the same level of like trust and care that we were, and actually kind of manipulated through that process. So my advice in that is like, even when you are getting along and you are friends, still go to it from like worst case scenario, even though you're friends. And also on the note of the partner is like, you may know your business partner very well, but maybe you don't know their spouse very well and what they're whispering in your co-founder's ear. And so really strong advice to like kind of go with worst case scenario, like absolutely everything that can go wrong, and make sure you're protected for that, because you really don't know what's going on in other people's heads, even if you are really good friends.
Yeah, and yeah, that's totally true. When you're doing this and you're getting along, but you are planning for worst case scenarios, right? And you can say up front, I don't think this will ever happen, love you to death, my co-founder. But let's plan for scenario A, scenario B, scenario C, and make sure that we've got them covered. We don't think it'll ever happen, but that's what insurance is for, right? Think of this as insurance in case the unlikely events happen. And, I have lots of examples of co-founder issues. Another one that's, something, so there were 4 people that started a company together out of a university. And they set up the company and they went 25, 25, 25, 25. And then only 2 of them wound up leaving the university to run the company. And, so the intellectual property that went into the company was sort of an equal split between the 4 of them. But the sweat equity was not equal. So 2 of them were doing all the sweat equity, 4 of them had contributed the intellectual property. And that 25, 25, 25, 25 made no provision for the sweat equity of the 2 that were running the company. And then then the 2 running the company were like, hold on a second, what am I getting?
This is not fair.
Yeah, this isn't fair. Yeah, so, and it was a very difficult conversation at that point on how to redo the equity to reflect what was going on in the actual operating of the company. And they hadn't at the beginning had the question of who's actually planning to leave their university jobs in order to do this. They avoided that early awkward conversation and wound up with a much worse conversation a year and a half later. So definitely worth going through this. If your co-founder is, at a university, and I'm not sure if that's the case for any of you on the call, but it's not unusual for intellectual property coming out of the university that one of you is a professor and one of you is going to run the business. And how do you reflect the contribution between the IP of the professor and the sweat equity of the person running the business? So those sorts of things are the things that you want to be working through in that co-founder agreement. Question in the chat around vesting timelines for a co-founder agreement. 5 years is not unusual as a vesting timeline. And then the reverse vesting, if there's no exit event, the shares start coming back into the company, is another thing to look at in the agreements. But there's lots of ways to deal with it. But yeah, 5 years is not unusual. So 20% a year.
Yeah. That's typically what I see.
Yeah.
Great. I think that we're done. So I don't know if there are any other questions, or Katie, time-wise, are we on target here, or where are we?
Yeah, we're actually early, which is exciting
Awesome.
for the founders. So we skipped our break, but for everybody on the call, I'm sure time back isn't a bad thing. Does anyone have, to just reiterate what Lorraine said, does anyone have any questions pressing? We're going to give like 30 seconds for you to process all that has been said. But is there anything pressing that wasn't addressed, or anything we can do to support you? The slide deck is already available in the founder share. I'm going to make the recording of this session. It's obviously it's heavy content, a lot of information to take in at once. So I'll make that available right away.
Yeah, and I'll give you, because we didn't we didn't talk about all of the different terms because I mean, it's quite overwhelming. But we do have a glossary of terms that just gives you a, here's the acronym that'll get thrown around at you, and this is what it means. And then when you're looking at things like a cap for a deal, or you're bringing in new investment, you'll need to get familiar with pre-money valuations, post-money valuations, and the conversion math of pre and post valuations. So there's some good websites around the conversion math in terms of the order of events. If it's a post-money cap or a pre-money cap, and what the order of conversion events, so that you can, because once you get your cap table set up, you're going to set it up in Excel. You're going to have your, typically, and I think we've got a session on cap tables, right? Yeah.
Yeah.
So typically on your cap table, and you'll learn more about this, you're going to have your first tab on your cap table is your equity. Your second tab on your cap table might be all your notes, or it could be your first convertible note. You've got a tab which has your safe on it. And then the reason you want to do it in Excel or Google Sheets is you want to set up all your formulas so you can do your practice math and see at different valuations, at different pre and post money, how much do you own at the end of the next round of investment. And you're going to be wanting to go through that because you want to make sure you own enough to make it worthwhile for you, and for the investors to be confident that you are committed enough financially to keep going to make this successful. And so those are the things, and if someone negotiates a post-money cap, so if you look at the Y Combinator safe, and I don't know if any of you have looked at the Y Combinator safe, the current Y Combinator safe is a post-money cap. The old Y Combinator safe was a pre-money cap. The math is different. And the difference in the math is in the pre-money cap, the safe holders get diluted at the same rate that you do. In a post-money cap, they don't, because the post-money cap happens in a different order, so you get more diluted than your safe holders do. So these are the things that you need to be looking through. And as I said, there's lots of calculators out there that you can run things through to help you set up your spreadsheet, so that you can do the practice math and see how you get diluted in the round versus your early investors. There was a question. Somebody had their hand up.
While somebody mutes to also ask their question, there were a couple questions in the chat about templates, like cap table templates. I know in our cap table, in our next session, it's split. So it's talking about data room management and also cap tables and stock options. Kayla will be joining us and leading that session, and she does walk through a basic template, also a great resource in follow-up. So you'll have access to Kayla, and she'll be added to our advisor list as well. So any questions that come out of that too. So you'll have more resources. And Tally, I think you had your hand up for a little bit.
Yeah, I don't want to take up too much time because I know we're at the end, but someone mentioned something about how we should get NDAs before we disclose financial details. But I feel like, in the real world, so to speak, investors like sort of laugh when you ask them to sign an NDA, and they feel like they are entitled to, well, in my experience, they've sort of said like, oh, come on, like, really, you don't trust us, like, we're doing you a favor by talking to you, type of thing. And they end up seeing everything. So that's just been my experience. Like, you don't ask people for NDAs if you think that if you need something from them.
So as an investor, I can sympathize with you, Tally. So I think you should, so basic financials, you should be prepared to share those without an NDA. So your basic projections, I'm going to be at, I've got 0 revenue today. I'm going to be at 100,000 next year. I'm going to be at 400,000 the year after. I'm going to be at 10 million the year after, and I'm going to hit profitability in year 3. Those sorts of projections, public. You're not going to get anywhere if you can't talk to an investor about that level of financials. Going into detail of, so sometimes the types of people that you're hiring are very related to your IP, your trade secrets, things like that. And you might be giving away a lot of information about your company when you're giving more detailed financials. And so asking for an NDA is not unreasonable to get into a data room. Right? The level of information, you should be able to do a 15-minute pitch and a Q&A without an NDA.
Yeah.
You're going to get very few investors who are willing to sign an NDA for a 15-minute pitch and a Q&A. Most investors will expect to be able to get through a deep dive without an NDA, which is an hour, hour and a half with you with more detailed questions. Most investors would not be surprised to be asked for an NDA to go into the data room. And if you've got, patents that are not yet issued and you've got investors asking about that sort of thing, absolutely you want an NDA.
Yeah.
So you want to be able to layer it. And the more committed the investor is to investing in you, the more likely they are to sign an NDA. So when they're not committed yet, you want to keep your information at a level where you don't need an NDA, where they can't do damage to you if they head out to a cocktail party and tell all their friends about what they heard during the day.
Right.
Which does happen, right? Investors, like we have a code of conduct at Capital Angel Network that says you don't talk about what you hear during the Capital Angel Network member meetings and the deep dives. But, people chat, they might be really interested, they say something. So you don't want to give them secrets that they might inadvertently blurt out when they're telling someone about how excited they are about your company. But when they are going into the data room, when they're starting to look at unreleased patents, your issued patents are public, but your unissued patents aren't. So if they want to learn more about the unissued patents, absolutely. If they want to understand your trade secret, absolutely you need an NDA. Otherwise, it's not a trade secret. So things like that. So just look at the level, and the more committed the investor is, the more likely they are to sign an NDA, and the more they're likely to understand how important it is to protect your company.
Okay, thank you.
Can I just jump in just to let folks know that all of the SheBoot investors sign a code of conduct, just like Jennifer mentioned with Capital Angel Network, as well as our Ghost Board volunteers, our coach volunteers. They all sign a volunteer agreement that includes an NDA and has verbiage about confidentiality, IP, and our advisors as well, just so you know.
Yeah, so this should be a safe forum because we've all signed stuff saying we're not going to sell your secrets.
Right.
But remember with investors, I mean, you have to hook the investor and you have to give them enough information to hook them. And, if I'm looking at 100 different companies in a month, I don't want to sign 100 NDAs, right? I'm only going to sign, maybe 1 or 2 of the NDAs. And so you have to hook me to get me to sign the NDA.
So much to think about. Have we scared you? I hope not.
And I'll just say, we're around. So, because I know you're going to be thinking about what your vehicles are and getting your data rooms ready. So as you go back and reflect on this content, you have questions, you can reach out directly to me, or you can talk to Katie and she can, get the questions to us.
Awesome. Okay, wonderful. Thank you both so much. Thank you, Lorraine, and thank you, Jennifer. So much good information shared, a lot to digest, but you'll all have access. And a quick reminder, I'm posting all of our resources after each workshop, all in Circle. And that's a great platform to be able to ask your questions too. I also shared the link to the Founder Share folder that's there. You have that in your inboxes. And after this workshop, I'm going to send you an email. I think it's easier to digest after all of this information. I think it's easier to digest the next instructions. But I'm going to send you the travel instruction document, which I referenced last week. Reminder to get ready for pitch practices tomorrow. So we have our first pitch practice with investors. So you'll have investors in the room and you'll be able to watch both yours and your pitch partners, which is really exciting. And then I'll collect all that feedback and also provide you and your coach with the video recording. The other thing to keep in mind, because we had this legal workshop today, and then of course we had our finance workshop last week, each of you have been introduced to your legal advisor and your finance advisor over email. And the option is always to go to them. And as Jennifer referenced, and Lorraine reiterated, always good to work with a legal advisor that has startup experience. So the legal advisors we work with have just that. And, those questions that you have popping up really can be shared with them, and they're there to support you during this time too. So don't hesitate to reach out to them and to book some time to chat. I know it's a lot in a very short period of time. But really, you'll have access to them now and then also post boot camp, so all the way up until March. So keep that in mind. And the other thing, we'll be doing check-ins with our data room. So I'll follow up via email, like I said, but just keeping in mind, this program moves incredibly quick, and the deadline to have your data room finalized for viewing of our investor group, so the SheBoot Angel investors, is, we're saying October 10th. You have until October 13th, but let's just keep October 10th in our minds, so that if there's last minute additions, we can have those ready for the 13th. But those will be made available to our investors during that time. So really is ideal. It's going to be for many of them the first impression. And of course, that's when they'll start going through and doing their first assessment prior to your actual pitch on pitch day. I don't know if Jennifer, you want to add anything to that? No. Just get those data rooms ready, and your coach is there to support you too. And we do have our next session for the first portion of that will be with Nadia, who you all met at our launch event. So Nadia is a graduate of our program. She's done a successful raise, and she'll be able to talk to you about data room management. In addition to that, Melanie will be joining us too to just build on specifically addressing questions about due diligence. And then we'll have our cap table session with Kayla Kavanaugh and Julia Elvidge will be there too. Who you
Yeah, and
well.
actually I do, just on the data rooms, what I would recommend, and I said it before, is everything that you already have, just get it into your data room. And then look at where your gaps are and just create a task list for your gaps. Do you need help to fill the gap? Do you need, a legal advisor? Do you need a financial advisor? Do you need your coach to help with the gap? But document the gaps, but get everything that you already have in. It'll give you a feeling of accomplishment that it's not empty, because you will have some of the stuff already. And then it will help with organizing your time. And your coach can help with prioritizing the things, what your gaps are, prioritizing those so you get the most important ones done first. In case, you run out of time. Not that that ever happens, but that you've got the core documents done.
Yeah. And reminder for those as well, we've shared this and it's in the resource folder in the founder share folder. There is a template that was actually created by used by one of our founders. So it was a founder developed template, and it's an easy, quick way to manage to really visually see your progress.
Hey,
Link
Eddie,
to
hold
the
on,
documents.
cooking anything.
Oh,
I have just a quick question for you, Katie.
Yeah.
When it comes to the data room, the
process that we're working with the like our actual one-on-one mentors is to get feedback on that. But then as we work, we also work with you directly to kind of go over some more feedback too on the side to see if there's anything we should change? Or do you think working with just directly on the mentors is fine?
Working directly with the mentors is fine. And as well, you do have access to, from an advisor standpoint, you can also lean on Melanie and her her peer, like her advisors as well that she works with. And Nadia is one of them too. So if you
Okay.
do want to go elsewhere, absolutely. But you have no obligation to work with me directly or anything of that sort. So not that I would pass up a chance
I
to
was
work
gonna
with
say,
you
are
guys,
you
but-
passing it up? Come on.
No.
Okay, no worries. Thank you.
No, I'm always here. But yeah, that, you know, just come if you have questions or concerns or would like to be put in touch with somebody, or have really a problem area that I can help address. Yeah. Okay, no more questions. This was so great. Feedback form is the best way to let Lorraine and Jennifer and me know how great this session was today. As I said, I'm going to work as quickly as I can to make all these resources available for all of you. And anything after the session, come to us. Don't hesitate. Thank you all very much.
Thanks, everyone.